Hi friends! So today we're going to talk about round 2 of the accounting cycle. Welcome back. So today we're going to talk about the second part of the accounting cycle. If you're just now joining us, then I've put a link to the first part of the accounting cycle, and I would encourage you to go watch that video first before you jump into this one. All right, so as we've discussed in the past, accounting is very fundamental, foundational, and you have to understand parts 1 through 4 before you can understand parts 5 through 8. Okay, so at this point, you should have a really strong grasp on accounts, the type of accounts, the normal balance of an account, and how they react when they increase and decrease. Remember, there's no such thing as just an increase or decrease. We talk debits and credits, and we discussed that in the first video. All right, so now today we're going to get into the last part of the accounting cycle. So parts 5 through 8 are contingent upon parts 1 through 4. So as I stated before, you have to understand parts 1 through 4 before you can understand this part. All right, so last time we left off, Miss Yin had been doing all kinds of transactions. She's been making money. She's been spending money. She started her business. And now at this point in the cycle, she's at the end of her first year. Woo! She made it to the end of the first year. But what does that mean from an accounting standpoint? It means we have to do some things we haven't done before, okay? So we're going to pretend that Miss Yin is a normal calendar fiscal year, which means her year is from January to December, all right? So we are looking at her information at December 31st, the end of the year. Okay, so what you can see now coming up to your screen is a lovely trial balance from the end of the year. All right, this is all of the transactions that we have recorded throughout this period of time, and it's summarized once again in this trial balance, which is just so beautiful to look at because it just has everything summarized and the correct balances, and everything is just looking so nice and clear. All right, so first, what's going to happen is you're going to look at the trial balance, and you're going to probably notice that we ended in a different place from where we did in the first video. That's because Miss Yin went on to buy a few other things like supplies. She prepaid some of her insurance, which we call it prepaid insurance. I mean, duh. But the thing to note is that prepaid insurance is an asset because we have prepaid something that we're going to use later. So it's like prepaid. If something happens, they owe us that money back. That's an asset to us, okay? All right, so those are some of the new things that you'll notice on the trial balance, all right? And so also what you'll notice is that our cash at December 31st was $32,100, and then so on and so forth. We had $18,000 of accounts receivable. We had some equipment, of course, of $36,500, some supplies, some prepaid insurance. We had some, accounts payable. We had some common stock. We had some dividends. We had some service revenues because of course we're all about trying to make some money, and then we had a couple of expenses, rent expense and wages expense. Okay, so now we're ready to go into step number 5, which is to prepare some adjusting entries. Okay, so before we go into the actual adjusting entries, let me just take a moment and let you know that this is typically where people start to get lost. And the reason they start to get lost is because they don't understand parts 1 through 4 of the accounting cycle. Like I said, if you don't understand debits and credits, if you don't understand left and right, if you don't understand the normal balance of these different accounts, then you need to make sure you understand that before you go into the next 4 parts of the accounting cycle. Okay, so as you can see, you're looking at the trial balance on the screen. You see all these pretty colors that, Professor Nance just loves the colors. And so we have color coded this Excel spreadsheet that I'm going to walk you through so that it can be easy to read. And just as a side note, if you would like to download a copy of this Excel spreadsheet so you can follow along, then please feel free to do that. The link is below in the bio. All right. So basically, we do these adjusting entries. We can do them old-fashioned way like journal entries, but we already talked about journal entries. We did that last time. This time, we're going to fill out what we call the accounting spreadsheet or worksheet, okay? I love this worksheet because I love Excel, but also because it helps you see all of the details, all of these next 4 steps of the accounting cycle in one place, okay? And if you really like Excel like I do, then you build a couple of formulas and then it can calculate by itself. Oh, I love that because it helps you not make errors, okay? So I encourage the spreadsheet. You still have to know how to use the journal entries and the post to ledger and all of that stuff. But anyway, so we're going to jump right into it. An adjusting entry is basically, you get to the end of the year, right? Okay, so December 31st. We're December 31st. Okay, there's some things that we need to record, but nothing has happened, right? We didn't get like a transaction. Nobody called us up and told us to do anything and things like that. And so, we're just supposed to know how to do these things. This is where the accountant brain really comes in. It's like, we gotta, yeah. So that is what an adjusting entry is. Nobody tells you to do anything. You have to take the initiative to do this because you just know that it needs to be done, okay? So we're gonna start going into our adjusting entries. So today we're gonna record 6 adjusting entries, and as we stated, this is step number 5. All right, so the first adjusting entry is that at December 31st, we owed, remember, we record expenses when what? They are owed, not paid, when they're owed. Okay. So we owed $3,000 worth of wages to some of our workers, but it had not been paid at December 31st. The entire purpose of an accounting period is to record all the costs associated with that period in that period, okay? So these wages are a part of this year. So even though we haven't paid them yet, we owed them in this year. We want our financial statements to depict everything that happened in this year, so we got to record them, right? Remember, nothing happened. Nobody said anything. You didn't pay anything. No transaction transpired. Nothing happened. But we just know, because you're an accounting guru now, that we have to record this, okay? So $3,000 of wages. So no cash is taking place. So we know that cash will not be a part of this journal entry, okay? So the first part is we're going to record that wages expense, and then the second part is going to go to wages payable because we need to pay it eventually. Remember, anything with the word payable is a liability, right? Okay, and so as you can see in column 2 of the adjustments section, we're going to have a debit to wages payable, wages expense, because expenses are left side accounts which act like assets but totally are not assets, but they increase with a debit, right? Remember that stuff from part 1? All right, so we're going to record the expense in the column for debit, and then the payable portion is going to go in the right column under credit, okay? Because it's a liability. All right, number 2, depreciation has been so depreciation. We're going to go a lot deeper into depreciation a little bit later, but for right now, we're going to keep it on the surface, okay? We're not going to dive into depreciation because that's a whole video by itself, okay? It's a whole conversation by itself. But depreciation, we need to record some depreciation. We have $4,000 of depreciation. Anytime you record depreciation, the journal entry is going to be the same. It's always going to be a debit to depreciation expense and a credit to accumulated depreciation. Now, accumulated depreciation is a brand new account and you haven't heard of it before, but it decreases the value of the equipment. Therefore, it is not an asset because equipment is an asset. It's what we call a contra asset because it decreases an asset. If it decreases equipment, which is an asset, and increases with a debit, then that means we're going to have to credit accumulated depreciation to increase it. And once again, that is something that we're going to go a lot deeper into in the future, but I have a contra asset, a whole video dedicated to contra assets or contra accounts that I'm also going to link down there just for you. All right, so make sure you check that out. Okay, so debit to depreciation expense, credit to accumulated depreciation for $4,000. Now, the third thing is that we currently have $6,000 worth of supplies on hand. Okay, so this is the tricky one, and everybody always gets this one wrong because it's so tricky, and that's why I love it. So I'm gonna help you through this. Okay, all right. So a physical account, the physical count of supplies at the end of the year shows that we have $540 of supplies on hand at the end of the year. So we started with $6,000. And we only have 540 left. How do we get from 6,000 to 540? That's right. We have to subtract $5,460. Okay? So the amount that is listed in number 3 is not the amount of the journal entry. That's what we have left. We need to figure out how we're going to get from what we had at the beginning to what's now left over. And the difference between those, that is the amount that we're going to record, okay? You're going to record that by debiting supplies expense because you've used them up. We've used up these supplies, and we're going to credit supplies. So this is not a payable. We're taking the asset supplies and we're bringing it down, okay? All right, so that's a tricky one. Everybody always gets that one wrong because they want to use the number that is provided in the sentence, okay? We prepaid it. We were like, you know what? We're just going to go ahead and pay $2,400 for the next 12 months and not have to worry about it, okay? Okay, so the fourth entry that we have to record is based on the fact that we bought some insurance on November 1st. So we're at the end of the year, and now 2 months have expired. That means it's no longer prepaid for those months. We now have to convert it into an expense, an actual insurance expense. Okay, and so we're going to do that by debiting insurance expense for $400 and then crediting the prepaid expense for $400. So we're increasing the expense and then decreasing that asset because we no longer have all of that prepaid. So now we just have $2,000 left in the prepaid insurance. The fifth entry is that we earned $500 of interest revenue. So apparently we must have made a loan to somebody, which is cool. We'll take the money how we can get it, I guess. So we're going to record that. Somebody they owe it to us. They have not paid us yet, but they owe it to us. So we're going to debit interest receivable because that's an asset to us. We're looking to receive this $500. And then we're going to credit interest revenue for $500. All right. And then the opposite for number 6, the last adjusting entry, is that we owe $1,000 of interest expense. So apparently along the way last month, Miss Yin went and got a loan from the bank. Okay. So she owes some money to the bank for the interest. She's not paying it. She owes it. So she's going to debit interest expense for $1,000 and she's going to credit interest payable for $1,000. Okay. All right. So those are all the adjusting entries. Of course, there can be like so many other adjusting entries, but the thought process is these are things that have happened that nobody tells you. Nobody gives you the heads up and say, hey, you need to do this. You need to do this. You just have to remember to record it because we want our entire year to be all inclusive. Okay. All right. So now what you're noticing is column 2 of our lovely worksheet has now been filled in with all of these adjusting entries. Okay, so all of the adjustments have been made, and now as you can see at the bottom of each row, there's always a check figure. The debits always equal the credits. And Professor Nance, my heart is just so happy because the debits always equal the credits. There's going to be one exception, and I'm going to show it to you. But for the most part, these columns will never fail you, okay? And then you can see the next set of columns is now number 6 in our accounting cycle, the adjusted trial balance. Now we had the unadjusted, then we just adjusted it with these adjusting entries, and now it's adjusted. And what does that mean? It means that we are finally finished with our books. We love these numbers. Everything is good to go. All right. So what do we do next? We make some financial statements. Now we're ready. We're like, okay, all of the information is there. We are ready to make some financial statements. So just really quick, before we leave the adjusted trial balance column, you'll notice stuff has just been auto-populating, right? As we filled in the adjusting entry column, what happened is Professor Nance loves Excel, and so there's some formulas already in the adjusting trial balance column. All right, so I will leave it to you to go and play around with those formulas, and feel free to leave a comment for me if you have any questions about that. And also let me know, do you want me to do an Excel video? Because I would, yeah, we'll talk about that later, okay? All right, so back to where we were. All right, so we now have our adjusted trial balance, and we're ready to start some financial statements. Preparing financial statements from the adjusted trial balance is so easy. And first, let me say, financial statements is number 7, and that is our 7th step in the accounting cycle. So all we literally have to do is draw a line on our adjusting trial balance. Everything from the top, from cash down to dividends, belongs on the balance sheet, and everything from revenue, service revenue, down to interest expense belongs on the income statement. It's that simple, friends. That's why I love the worksheet, because it's like it's all there, okay? So all right, so everything from the top, you'll notice, is automatically just feeding over to our balance sheet category, our balance sheet column, and then everything on the bottom is now flowing over to our income statement. That's it. So we're not going to go into it. We got a special video for that. Then I'm also going to post down here in the link. We have a special video for the financial statements that we already talked through all of that detail. So I will leave it to you to go look at that. Now we move into the final step of the accounting cycle, which is to close your books. All right, so we talked a little bit about the fact that in the financial statement video, we talk about like the difference between some of the accounts, like the balance sheet is like a snapshot in time, the income statement and all the rest of the statements like flow, and it's just like over the period of time. Well, at the end of the year, the balance sheet information is going to stay. It's like, I'm permanent. I'm here to stay. You don't want your cash to go away anyway, right? I mean, duh. You don't want your equipment to go anywhere. All of your balance sheet accounts are going to stay. Now, your income statement accounts are what we call temporary accounts. They are not going to stay. We have to close them. The reason we close them is because we want to get our financial statements ready for year 2, right? We're not going to go into year 2 with any revenues or any expenses. That happened last year. We told that story already, okay? We're starting a new chapter. And therefore, to start a new chapter, we got to prepare our accounts, okay? That is what the closing entries do. It helps us prepare our accounts for the next year. Okay, this, my friends, is, in addition to the adjusting entries, this is the things that always mix up students. You have to understand the normal balance of revenue accounts and expense accounts in order to understand how to close them, okay? Because you're just going to do the opposite, right? Like if I have a debit in this account, how do I close out a debit account? I credit it, all right? It's just the opposite. Okay, so all you have to do is to close the accounts, you're going to do the opposite. And remember, it's just for our revenues and our expenses. So our revenues normally have what? A credit balance, right? So to close them, we're going to debit them, okay? Our expenses normally have a debit balance. So to close them, we're going to credit them. All right. So typically you never debit a revenue and you never credit an expense. That's like weird. It's like negative. Like who does that? Who has negative revenue and who has negative expense? The only time you should ever do that is if you made a mistake, of course, or if you're closing them at the end of the year. But so in our worksheet, we have a column for that, and you'll notice that it's almost like a mirror. It's like they're just mirroring each other. And then we're closing them out. And then the final column is the post-closing adjusted trial balance. I know it's a really long name. The post-closing trial balance. And my friends, that is it. Okay, that's it. I dropped the mic, my piece of paper. I'm like knocking stuff over. That's it. You're finally done. You have just completed the accounting cycle. Woo! We are done. All right. And so with that, I mean, what is there left to do but to go ahead and get into our stance and do our dance so that we can get out of here. All right. I will see you next time.